Hey traders, welcome back to Trade Empire. Today in this video, you will learn the liquidity trading strategy. As we all know, that learning the liquidity concept can increase the winning ratio and it can save us from a lot of liquidity traps. In this video, we will share our best liquidity trading strategy by Smart Money Concept. See you after intro. The first question is, what is liquidity? Liquidity means money, means the ease with which a market can be traded without affecting its price. As we know that every trade is a transaction between sellers and buyers. So, if there is more money in the market, there will be more liquidity. And it makes it easier for big players to trade. Next question here is, where are the liquidity zones? Liquidity zones are there, where retail traders or small banks enters in the market. Here on the chart, we can see there is a downtrend in the market. And price is making lower lows and lower highs. And this is the recent pullback by price. And we also have a red candle here at the end of this pullback. And the retail traders here will expect that price will again come down from here and it will continue its downtrend. And many of the retail traders will execute their short position here. But they don't know that the liquidity zone is above this swing high. Because we have this bearish order block at the start of this impulsive move, that left an efficiency behind. But a beginner retail trader will ignore this order block. And he will expect that price will go down from here. But when a lot of retail orders will placed here, then market will go to grab the liquidity at this order block. And then the price will continue its direction. The next question is, what are the benefits of identifying the liquidity zones on the chart? The first benefit of identifying a liquidity zone is that an existing liquidity zone, before an order block, can give us a good trade opportunity, as we know that liquidity is a fuel for the movement of price in the market. And the second benefit of identifying a liquidity zone is that you can distinguish liquidity areas with a less chance of working from major supply and demand zone. Here on the chart, price makes a clean change of character, indicating a trend shift in the market, and it left a demand zone or bullish order block here with great inefficiency. And we expect that price will come to this order block, then we will find a long opportunity here. But after this impulsive move, the trend got exhausted. And see that how many times price created liquidity zones here. As I told earlier that liquidity is the fuel for price movement. And after that, it grabs the liquidity and took out the early buyers and starts moving to the upside. And here's an important point. Grabbing the liquidity before reaching an order block can give us a good trade opportunity. But it is not necessary for the price that it will tap the order block and starts moving upward. Price can easily break through the order block, and it can change its direction. That's why we always combine some other factors like looking for a trend reversal in lower time frame. And after full confirmation, we execute the trades with low risk. The next topic is the types of liquidity in the market. There are many types of liquidity zones we can found on charts, like consolidation areas, trend lines, and sometimes even swing lows and major moving averages. But the most important liquidity zones are below equal lows and above equal highs. That's why we mainly pay attention to equal lows and equal highs to keep things simple and easy to understand. But first I will show an example of trend line liquidity grab. Here on the chart, we have a clear price movement above the trend line. And what we notice here is that price is not creating clear higher highs and higher lows. Price is just creating liquidity zones here. And after grabbing the liquidity below the trend line, the price makes a sharp move to the upside with heavy momentum candles and break through the structure. And here's an example of equal highs. Remember, we will look for equal highs when market is in a downtrend. Now look here, we have this sharp bearish move. And after that, price formed these equal highs, instead of making a new lower low. So, we will mark this area as a liquidity zone. And we expect that price will grab the liquidity of these equal highs, and then it will again move downward. And here, the liquidity above the equal highs has been grabbed. And price has took out the early sellers. Now price has enough fuel to go down with full speed. Here's an example of equal lows. Remember, we will look for equal lows when market is in an uptrend. Here on the chart, price breaks through the structure. Means we have an uptrend. And instead of making a new higher high, price makes these equal lows. And we mark this area as a liquidity zone, and what we expect here is that price will grab the liquidity below the equal lows and took out the early buyers, then it will continue its uptrend. And that's what actually happened. Price grabs the liquidity, took out early buyers, and got refueled, and continue moving upside. Now you have understood the concepts of liquidity. Let's jump into our best liquidity trading strategy. And if you are enjoying the video, please give us a like to show your support and your interest in our videos. This trading strategy can be applied at any time frame and in any market like Forex, crypto, and stock market. The strategy is very simple and easy to learn. The first step we do here is, we applied the 50 moving average on the chart to identify the trend. And if price is moving above the moving average, then we are in an uptrend. And we also have a break of structure here. So the uptrend is confirmed. And until the price is above the moving average and extending the higher highs, we will only look for buying opportunities. And the next step we do is to identify any liquidity sweep pattern. Means that we will wait for the price to make any support while coming down for retracement, and then grab the liquidity below that support. Price can grab the liquidity by closing a candle below the support, or it can grab the liquidity only by wicks. Both are valid. Now look here, after this sharp move, price come back for a pullback and make this support, and then grab the liquidity below the support by closing the candle below. So we can execute a long position here at this long wick candle. Stop loss will be below this first bullish candle, and for take profit, we can target the key level of higher time frame, or just 1:2 risk and reward ratio. And after full confirmations, we have a winning trade. And here comes an important point. Always keep an eye at higher time frame to see where the price is and how much space it has to go to the next key level. Let's take a look at a bearish example. Here the price is moving below the 50 moving average. So we have a bearish trend, and we will only look for selling opportunities. And after this sharp bearish move, when price go for a pullback, it make a resistance here, and then grab the liquidity above resistance. So we can execute a short trade here, stop loss above the wick of this candle, and take profit will be the key level of higher time frame, or just simply 1:2 risk and reward ratio. And we got a winning trade here. Remember, before applying any strategy in real market, always backtest your strategies on demo trading to avoid big losses. If this video has been useful to you, please give us a like and subscribe the channel for more interesting trading videos. Wish you good luck for your trading journey.